The market just had its worst day since 2020. The S&P 500 is down nearly 5% in a single day, and beginner investors are panicking. Historically, this is the lowest it has gone since 2020 and probably after the 2008 stock market crash. So what do smart investors actually do during downturns like this? You will find out in a minute. In this video, we will break down what is happening with the market right now, why market fluctuations are normal and what history teaches us, 3 practical strategies you can use to manage your investments during these down times. Remember, this content is for educational purposes only and not financial advice. Always consult with a financial advisor before making investment decisions. Let's dive in and make sense of the current market situation together. The S&P 500, which represents 500 of the largest US companies, has recently seen a decline of about 4.8 in a single day. Yes, this has understandably caused concern among investors, especially those who are beginners. But what does this really mean? Imagine the stock market as a heart monitor. Just like the heart rate goes up and down depending on your activity level and your health, so is the stock market. The market naturally experiences rises and falls. These fluctuations are a normal part of a healthy market. The key point here is that short-term declines are common and don't necessarily indicate a long-term problem. This is why the experts will always tell you if you are not in for the long term, then don't venture the stock market. Let me prove to you with an overview of how the S&P 500 has performed over the past 5 years. If you take a close look at the chart on your screen, you realize that over the past 5 years, that is from 2021 to 2025 today, the S&P 500 has been on an increase over the period, even though there are periodic ups and downs. And that is exactly how the stock market works. There will be daily ups and downs, but if you are in for the long term, you will think more long term, and you realize that even though there will be days you get more, there will be days it will be in negative, but at the end of the period you are investing for, you realize that your investment will still rise. On the other hand, if you look at the second chart on your screen, indicating the last 6 months of how the S&P 500 has performed, you realize that it has always been on the downturn. This is indicating that from November up to this time in April, the S&P 500 has not really performed well. That does not mean that it's not performed in the long term. This has just been a short-term dip. Here is the key. Just because it is down today doesn't mean it stays down forever. Markets have seasons, just like the weather. You wouldn't panic in winter because it is cold, because you know that spring is coming and it's going to be warm. And in investing, market springs follows downturns if you stay invested long enough. This downturn actually presents a huge opportunity, and this is where a lot of people miss the bait. Warren Buffett once said, "Be fearful when others are greedy and greedy when others are fearful." So what do smart investors actually do during downturns like this? They become greedy and buy more. While the fearful investors are panicking and withdrawing their money, smart investors buy more because it becomes cheaper. Why does staying invested matters? In order to explain this very relatably to you, I am going to use 2 people as an example. So meet Sarah and James. They both started investing into the S&P 500 at the same time with £5,000. They invested additional £1,000, making it £6,000 in addition to the returns they've been making over the period. The market began to go down and they lost almost £800. At this point, the £800 is regarded as a paper loss or a temporary loss if your money remains in the investment. But as fearful as Sarah was, she panicked and decided to sell her investment to cut her losses because she couldn't stand to see her money go down by almost £800. She withdrew her money and got $5,200 back instead of the $6,000 she invested. At this point, the loss has become a permanent one because it has actualized. She has withdrawn her money, so she has actually lost £800. On the other hand, James decided to stay in the market because he understands how these things work. Instead of panicking and withdrawing his money, he kept buying more. So he kept investing more money into the market. He was able to buy a lot of shares at a cheaper price because of the fall in the prices. The market rebounded and James never actualized the £800 temporary loss. So I hope you are getting the understanding, and that is how the investment world or the stock market works basically. This is the time the experienced investors come to the market because they know people like you will sell your investment. So they'll come and buy them at a cheaper price. They'll keep buying them. And then by the time the market starts booming again and the prices are going higher and it looks attractive to you and you want to come and buy, that is the time they will sell. So they will sell to you at a higher price and then you will think you are buying something good. The downturns will never go away. They will come again because there are things that influence these things. So by the time the market starts dropping again, you start panicking again, and then the experienced investor will come back to the market and come and buy from you again at a cheaper price. If it starts rising up again, you will come back again. They will sell it to you at a higher price. So they will keep making money from you. And that is how these things work basically. So now that we understand how these things work, what are the specific strategies you can employ to navigate this market fluctuation? I am going to present to you 3 different strategies. Number 1 is the dollar cost averaging. What is it? Investing a fixed amount of money at a regular intervals regardless of the market performance. So if you decide to save £100 every month for the next 5 years, regardless of the market price, whether it is going down or going up, you keep investing. You buy more shares when the prices are low and you buy fewer when they are high. Overall, this will potentially lower the cost of each share you buy in the S&P 500 or any company in the stock market. Think of it like this. Imagine your favorite sneakers usually cost £100, but today they are on sale for £70. Would you say, oh no, they are cheaper now, I better wait until the price goes back up to buy them? Of course not. You would probably say, wow, I am getting the same value just at a discount. That is exactly how long-term investors think. During market downturn, when prices fall, you are getting the same great companies like Apple, Microsoft, and Google for a lower price per share. So if you are consistently investing every month, a dip in the market just means you are buying more shares for the same money. That is the power of dollar cost averaging, and it adds up over time. Number 2 strategy, diversification. What does it mean? Spreading your investment across various asset classes like stocks, bonds, and real estate and other sectors. It reduces the risk because different assets may perform differently under various market conditions. Example, while tech stocks might be down, healthcare or utility stocks could be stable or rising, balancing your portfolio's performance. Regardless of what is going on in the market, people will still be going to the hospital, people will still be eating, people will still be drinking, people will still be using energy, people will still be using fuel, and so many things. So regardless of what is happening in the market, some stocks will still be performing. So this is the time to diversify. Number 3 strategy is to build an emergency fund. What is an emergency fund? Setting aside 3 to 6 months worth of living expenses in a readily accessible savings account. Let me put that in context. Assuming your living expenses for every month is £1,000, then you need to save like £3,000 to £6,000 into a readily accessible savings account. That is an account that you can withdraw your money within a day or 2 if you need it. That way, if anything happens, you would have something to cushion you whilst you plan on what to do next. If you are already investing in the stock market and you don't have an emergency fund, you are playing a very dangerous, risky game. Having an emergency fund allows you to cover unexpected expenses without needing to sell investment at a loss during market downturns. This is also the best time to have some physical cash at hand, just in case. The conclusion is that staying invested and focusing on long-term goals is generally more effective than trying to time the market. So what steps can you take right now to strengthen your investment approach? Here are some clear, simple steps you can take today, even if you are brand new to investing. Review your financial goals. Are you investing for retirement, a home, or a long-term wealth? Knowing why you are investing makes it easier to stay calm during short-term noise. Stick to a plan. If you have built a solid investing strategy like monthly contributions to an index fund like the S&P 500, stay consistent, let the plan do the work. Avoid reacting to headlines. Markets move daily based on news, emotions, and even rumors. Long-term success comes from tuning out the noise and focusing on your time horizon. And then number 4, keep learning. Subscribe to reliable channels, read beginner investing books, and follow experienced investors who promote discipline, not hype. Talk to a professional. Remember, nothing beats getting advice tailored to your personal situation. A licensed financial advisor can help you make smart, informed decisions. Here is the big picture. Yes, the market is down. Yes, it is scary if you are new, but history has consistently rewarded those who stayed invested, not those who try to time every dip. Even Warren Buffett says the best time to invest was yesterday, the second best time is today. So if you are in this for the long run, stay calm, stay consistent, and stay curious. If you found this video helpful, subscribe to the channel to become a part of the community. Like this video to help other people discover this valuable information, and share to a friend. Let me know in the comments what your plans are in this downturn. Are you staying invested? Are you going to sell based on the pressure coming on you? Let me know what you do in the comment section.